Good morning again. I'm Brett Graffy.
And I'm Griffin Gildea.
And both members of the Marquette research team. So for the fifth Flash Talk today, we're going to be talking about getting real, the current outlook for real estate. And on the agenda, we're going to be in particular talking about sectors like the office. We're going to be talking about valuations and really the challenges of financing properties and real estate today. And finally, portfolio positioning. And with that, I'll pass it back to you, Griffin.
Thanks, Brett. Before we dive into the office market in particular and the downside in the sector today, I'd like to set the stage of where the market is today. As I'm sure you've heard in your conversations with consultants while discussing portfolio performance, but real estate has been quite volatile in recent years. The upward swing in valuation at the onset of the pandemic has since been stabilizing or correcting in recent quarters as the higher interest rates and lower liquidity have applied downward pressure to all property types. However, if you take a look at this chart, you'll notice that this correction is different than its predecessor in 2008, where all property types are softening to some extent. Sector changes and secular changes have clearly defined in and out of favor sector types. And to that extent, we can reinforce this notion of sector stratification by taking a look at a PRIA survey of expected sector returns. And to start with multifamily, overall demand for rental housing is likely to remain robust over the next several years. High job availability, the overall shortage in housing, and pent-up demand from millions of young adults have investors confident that real estate valuations, while despite some softening over the next few years, is going to return about 3.9% annually over the next few years. Investors are also confident about the industrial market as well. Companies are stockpiling inventory, consumer demand remains robust, and companies are onshoring or nearshoring their supply chains. As my colleague David Hernandez mentioned earlier this morning, companies are onshoring to insulate themselves from that global market volatility. More supply chains coming to the United States means more demand for industrial assets. In the same breath, retail will likely benefit from consumer demand as well. Grocery anchored or more broadly defined as necessity-based assets are expected to deliver reliable income streams of about 5.3% annually over the next few years. Retail has also largely benefited from taking a majority of its valuation cuts before the pandemic unfolded. The sharp decline in construction post-GFC allowed some of the oversupply in the sector to become digested, which has since supported supply-demand fundamentals. It's not until we take a look at the office market that investor sentiment takes a nosedive. High vacancies, significantly higher leasing costs, and broadly flat to declining rents have investors spook and thinking that valuations are going to decline by about 6% annually over the next few years. However, even for the beleaguered office market, there are some mitigating factors. Income is still expected to be generous, and landlords mostly hold less percentage of debt than they did in 2008. Lastly, the office market has become very asset-specific. There's this dynamic of the haves and the have-nots, which Brett is going to touch upon later in the presentation. But before I turn the keys over to him, I want to talk more broadly about the office market and some of the secular changes that are affecting the space today. And so to rewind, we can go to the beginning of COVID. COVID unfolded, and landlords were very hopeful that workers would return to the office in this large wave. Well, in reality, that wave has been more like a trickle, and that trickle has plateaued at about 86% for the NCREIF NPI benchmark. Whereas we've seen some sort of positive rebound by the other sectors, office has been left behind. And to no surprise, the main culprit there has been the resilience of remote work, the prosperity of it, responsible for about a 7 to 8% decline in net occupancy. According to the Wall Street Journal, about 61% of US companies permit their workers to either work part-time or full-time remotely, which is up from 51% at the onset of the year. There has been some success bringing workers back to the office, evident by that first green bar, but alongside new supply hitting the market, net occupancy is fading. Well, in the slide earlier, I mentioned 86% for the NPI. You may think to yourself, that doesn't warrant those jarring headlines you see in the news, doesn't warrant that underperformance you see in your portfolio. Well, where the NPI is limited is that it's a national figure. It encapsulates office assets across the country. What we care about are some of those target markets, the assets that are in your portfolios that are in those high target urban centers. And so what we did is we took data from key fob swipes. We took data from the average American worker going to the urban office, and what we found was that workers are using their office assets at about a 40% clip of pre-COVID levels. If you follow with me on the left-hand side, you'll see after that sheer drop in occupancy utilization, there was some positive momentum in 2021, as well as the first half of 2022, but that has since tapered off at levels of about 40 to 60% of what was seen. And on the right-hand side, you'll see that southern cities like Austin and Houston, large beneficiaries of the southern migration that unfolded during COVID, rest at the top, but still remain well below what was seen. You know, we here in Marquette, we've tried our best on our part to keep Chicago at that number 3 spot. Thank you, Brian, wherever you are. But in all seriousness, the left-hand side, the takeaway here is that in these once vibrant cities, these cities like New York, Chicago, Los Angeles, you have these buildings that are essentially empty for the greater part of the week. And that's not just a concern for the landlords, but that's a concern for the urban economy as well, as the lack of foot traffic is driving less revenues for nightlife, shopping centers, restaurants, and parking garages. City budgets have also become stressed as there's lack of funds being collected from public transportation. And so these landlords and investors must reconcile themselves with the fact that their once downtown trophy office asset is definitely not worth what it used to be, and most likely might not even be worth its underlying debt. And that's just not their concern, but it's a concern for the entire financial system, as there's millions and trillions of dollars of debt backing these buildings up. So just to take a look at near-term maturities expiring in the next few years, there's just under $2 trillion maturing by the end of 2025. One of the biggest problems today for borrowers is finding someone willing to lend them money. And as banks have pulled out of the space, liquidity has dried up, which has created this challenging environment for these borrowers. And for the borrower who may not have anticipated rates to increase as they have, or for the liquidity to drive as it has, they've found themselves in quite this refinancing pickle. And so what is even more challenging and troubling is some of these office assets coming due, evident by the about $306 billion maturing by the end of next year. And so when I'm talking about this refinancing pickle, we can kind of wrap a bow on this by just taking a look at 4 different types of loans in the commercial real estate space. And evident by these widening spreads and higher capital requirements, we can see that this environment has become way more challenging. Floating rate loans, for those borrowers who have the floating rate loans, they've seen their monthly debt costs skyrocket, which is deteriorating asset cash flows. And for these managers who are trying to push rents, there's only so far you can push them. Trees do not grow to the sky. And for the fixed rate loans, they're going to feel those pains when they go to refinance at the end of the day. And so I mentioned earlier that the office market is becoming very asset specific. It then follows that refinancing, whether the availability of or the options to, has become very asset specific as well, as terms are very dependent on an asset's quality, its occupancy, its tenant credit, and its location. This is a driving factor behind the office market becoming very twofold, the haves and the have-nots, which I'm going to kick the can over to Brett to talk about further.
Thanks, Griffin. So looking at office fundamentals and expounding upon this idea of haves and have-nots, what we mean by that is the A-quality office space, the office space that has come online really the past decade and a half, that's synonymous with things like rooftop decks, extensive eating options, some of the best views, and really some of the best locations in the city. We'll get into that further. Continues to do very, very well. In addition to that, it's really seeing the highest lease rates and highest rental rates and rewarding workers to leave their work from home environment and come into the office. As you can see with the chart on the right, with net new absorption north of 250 million square feet. And then on the other end of this, you have the have-nots. And this is the more mundane, run-of-the-mill office space that needs significant investment from landlords in order to get up to more modern standards. It's ballparked that anywhere around 15% of all current office inventory is functionally obsolete. In building on this stratification, so once again, tier 1, tier 2, think of modern assets. These are the assets poised to do best in this market. And then tier 3, tier 4, these are the assets that are functionally challenged, operationally challenged, as well as financially challenged. In addition to all of this, there's a number of different headwinds facing the market. So from the demand side, the fact is this pseudo work from home, work from the office situation doesn't seem to be going anywhere soon. And Evan said earlier, talked about millennials, Gen Z, Gen X, but individuals around my age are actually leaving urban centers for more rural areas, looking for a better quality of life and a better cost of living. In addition to this, on the supply side, you're seeing challenges with the fact that these tier 3, tier 4 assets that are B and C quality are not profitable at current rental rates and expense rates. And as these assets get older, they become less and less competitive and just more expensive on an annual basis to upkeep, which is why we're seeing really the greatest strength in valuations and cap rate in these tier 1 and tier 2 assets. So as investors and as allocators have exposure to all 4 of these tiers, what we're seeing is investors are selling out of these tier 3, tier 4 non-profitable assets in order to focus their time and energy and efforts on tier 1, tier 2, the profitable trophy assets. In looking at office demand forecasts playing out over the next 5 years as percentage leased and year-over-year rental growth, so you can see right now the spread or band between tier 1 and tier 4 assets is still relatively tight. It's around 9%. What's expected over the next 5 years, that band will expand 3 times to 26%. And then you look at year-over-year rental growth rate, it's concentrated in those tier 1 and tier 2 assets, while the tier 3 and tier 4 assets are getting left behind. It's interesting to note, though, that this is only happening on a quality basis. It's happening on a location basis. So looking at this going on in our own backyard. So walk a mile west of here, you're gonna run into the Fulton Market District, up and coming area, great area. This is not only some of the hottest office space in Chicago, some of the hottest office space in the entire country. And then where we're at here today, which is more central business district, central loop, this is one of the softer office markets in the city. In this central loop area, there's not been one single office transaction in the past year. So you have this bifurcation, strong top submarket, weak bottom submarket. It's playing out across the country in all these other different cities, such as New York City, DC, Denver, as well as Minneapolis. And so once again, this is not only happening on a national by national basis, but very much on a locale basis. And looking at the tier 1 opportunity set as a percentage of total market share, but then also total square footage in each market, and why this is important for investors and allocators, helps point us to the markets where you're gonna find the best assets and best opportunities. So by pure square footage, Dallas continues to have a high amount. Silicon Valley, it's a little bit different market, some challenges there. Washington, DC, as well as the Sun Belt continues to do quite well. This just really begs the question of then what do we do with these tier 3 and tier 4 assets? And this is where the repurpose or conversion trade starts to come into play. And what I mean by that, it was recently announced that a developer was converting a Times Square office unit into a casino. Just here in Chicago, there's federal and state tax credits for developers who repurpose LaSalle Street office into multifamily or rent-to-own apartments. The biggest challenge with this trade is very expensive and very time consuming. Some of these buildings are 80, 90, 100 years old. They're built with old building materials, have old windows, old HVAC systems, old plumbings. It's often just cheaper and less time consuming to tear down and rebuild. But the biggest variable here is price. And at what price can you do that? And just look quickly on this slide, just looking, this is at pure percentage basis, high correlation to the previous slide. So Dallas and Silicon Valley continues to have a high percentage, but then you have other cities such as Austin, Charlotte, Raleigh, and Nashville. Think of cities that had strong population growth in really the past decade, decade and a half. And as that population demand has continued to grow, so has office demand, which is why you see a lot of modern assets and tier 1 assets, which explains the high percentage. But there's the old adage that everything has a price. And if we go back to the global financial crisis as our guide, peak to trough, it was right around 8 or 9 quarters. Prices were down around 30, 35%. At that level, that's when investors started to step in or buyers started to step in, just as valuations became more attractive and so did future returns. If we look at where we're at today, going back to Q1 2020, we're at about 13, 14 quarters. We're down about 23%. So we're slowly starting to approach that 30% threshold that we saw in other markets. And this is the expectation that as prices continue to fall, that repurpose or conversion trade tends to make more sense. So we'll help developers or take old stale assets offline and either repurpose them or convert them into more interesting assets such as multifamily or rent to own or tier 1 and tier 2 assets. And then looking at how this has played out in just overall composition of the Odyssey Index across the 4 main food groups. As you'd expect, industrial and apartments have done very well. In the past 6 to 7 years, industrial exposure is doubled. A lot of that's driven by the e-commerce trade and the last mile distribution needed for e-commerce. Apartments grown about 300, 400 basis points. A lot of that's driven by record low housing inventory in the US, but also the rent-to-own preference. And then a lot of these trades have actually cut the other way for the other asset classes. So retail has been halved. E-commerce has killed retail. And then interestingly enough, office at one time had the largest composition of the Odyssey Index, and now has obviously been hardest hit by the work from home environment. The interesting thing to note here is if you look at the trends and look at the slope of these trend lines, is that these trends existed before COVID. COVID only intensified these trends and pulled forward those supply and demand dynamics that we see today. And with that, back to you, Griffin.
Thanks, Brett. It's uncertain just how bad this current market downturn will get. It's likely not going to be as severe as its predecessor in 2008, especially if the US economy avoids a deep recession and rates start to come down quickly. COVID and technology changes have been large disruptors to the office market, but as Brett mentioned, there's also that demographic shift occurring as well. As baby boomers and Gen Xers retire from the workforce, millennials and Gen Zers will become the majority, yet there will be relatively fewer of them, and even fewer who will want to come to the office every single day. And those that do are going to want to be rewarded for it, and that's where you're seeing this sector office stratification start to develop. Lastly, landlords are contending with both a higher base rates eating into cash flows, as well as a tougher refinancing market. If I just land this plane here, it's important to keep a steady hand as we adjust to this elevated rates and this new environment. Regardless of asset class, it's easy to get caught up in short-term market fluctuations. We'd like to remind you that from both a risk-return and risk-adjusted perspective, real estate will continue to play a long-term role in any portfolio. That is all we have for you today. Up next, we have our president, Nat Kellogg, who will be leading a consultant roundtable with fellow consultants Amy O'Connor and Mike Piotrowski. Thank you.